Hey guys, you're about to watch our group assignment presentation in regard to Delta company. Okay, it's gonna be four of us, me, Tia Julian, Samantha, Vincent, and Frishol. A little bit about myself. I'm in my second year of uni, majoring in data analytics, and I have a vision to encourage more women in IT industry. Okay, let's jump into it. We have four provided chart here. Both of the pie chart is representing how 3 years average cash flow distributed. The one at the top it's the outflow, which has 40% in the PP net, and the next chart, the one below is the chart inflow, which distributed evenly, as you can see. And then the third one, it's the chart on how outflow and inflow represented, and the line represent the net cash flow. And the fourth is the beginning versus ending cash. As you can see, the orange bar is how the company ended with the specific year, and the blue bar is how they begin the cash with. Next, horizontal analysis. What is horizontal analysis? Horizontal analysis is an approach to analyze financial statements such as income statement and balance sheets in the cash by comparing a certain period by the best year, which in our case it's 2017. Take one row for example. The total asset percentage change in 2019, it's 80%. Where is that come from? As you can see, the best year here, it's 2017, has the total asset 250 million, and the year 2019 has 400 million. So 400 million minus 250 divided by 250, which is the best year, we have 80%. It used to show company trends and growth pattern. For example, sales trend has moving toward growth, as you can see here. Meanwhile, the interest expense has decreasing trend. The next one, percentage change. What is that? Percentage change is the change in the value divided by the absolute value of the original value. Why don't we have 2070 in this case? Because we don't have the data of 2016 to be compared to the year 2017. As you can see here, percentage change of ABT, tax expenses, and net income, year 2017 to 2020 has the same percentage, which is 400%, and sharply slowing down after. The cost of goods sold is the only things that showing increasing trend. And as you can see here, none of the balance sheets has percentage change that show increasing trend. Now I'm gonna pass on to Samantha.
Thank you, Tia. Hi, my name is Samantha Miranda. My career aspiration is to complete my education at UTS, so in the future I can contribute to a positive work environment while learning and applying new skills in this innovative industry. Today I'll be presenting the next portion of our presentation, vertical analysis and financial ratios. Firstly, we'll look at the vertical analysis. Here we have performed this on both the balance sheet and income statement. Focusing on the vertical analysis of the income statement, we can see that in 2018 to 2019, cost of goods sold was rather moderate. However, in 2020, it spikes to 80%. That's driving a significant decrease in gross profits. This change could be driven by higher expenses in the production process, and we can clearly see that Delta's cost of goods sold and gross profits are a big issue. Next, we will discuss the financial ratio analysis, starting with liquidity. As we can see in the first graph here, Delta has generally a low current, quick, and cash ratios, which is remaining below 1. In the second and third graph, it is notable that net working capital decreases negatively in 2018 to 2020. This indicates that there are short-term liquidity problems. Next, we will look at profitability. Here we can analyze the ratios from 2017 to 2020. We can clearly see there's a steady rise in percentages each year until 2020, where there is a sudden and large decline, thus indicating Delta may be underperforming in generating revenues, profits, and cash flow. Delta must look into lowering costs, reducing inventory to increase profitability. Moving on to financial leverage. Overall, financial leverage ratios have either poor ratio or has decreased in the year 2020. This indicates that Delta faces problems to meet long-term obligations. As shown in the second graph here for financial leverage, there is a change in trend of equity multiplier times interest earned and debt service coverage rate in year 2020. If ratios remain poor and decline, the company may default to its debt obligations. Next, we will look at asset turnover. Here we can see that the inventory ratio remains between 3 to 6, indicating that restock rate and sales are balanced, which is very good. Shown in the first graph, Delta has poor receivables, payables, net working capital, and total asset turnover, indicating Delta may be in a financial distress and failing to utilize its assets to generate revenue. Net working turnover is especially negative in 2020 and 2019, meaning there is insufficient short-term funds to fulfill sales. Here in the second graph, we can see that day sales in receivables increases each year. This will negatively affect the nature of cash flows. Also, cash conversion cycle is negative in 2019 and 2020. This is a good thing as it may improve liquidity. Next, we will move on to market value measures. So here we can see that in the first graph above, that Delta has suddenly declined in 2020 in its earnings per share and dividends per share, which is not good. It is also evident that in the second graph under this, that Delta has a very high dividend payout ratio, indicating they are a mature company that is reinvesting money back, but paying more in dividends. We can also see that there is a decrease in 2020 for retention ratio and sustainable growth rate, which indicates Delta is not able to find profitable opportunities and may be at risk of stagnation. That's it from me.
Thanks, Samantha. And hi, I'm Zoetian, and I'll be taking 3 sections today in this presentation. The first one is time value of money, and let's talk about compound interest first. So for compound interest, we have the sum of money compounded periodically by a specific interest rate and resulting in a future value of that sum. And let's take a look at the diagram on the right. You can see the relationship between the different factors. For future value, it has a positive relationship with the present value, the interest rate, and the number of periods. And next, we have the present value and the future value of ordinary annuity. For both cases, we consider multiple cash flows over a number of periods. And we calculate the present value or the future value of those multiple cash flows. And you can see the corresponding relationships in the diagrams on the slide. The next section is capital budgeting. In capital budgeting, we look at, we determine the project feasibility using different factors. And for example, let's take a look at the diagram on the right. In the scenario 3, the net present value is lower than 0, and whereas the rate of returns are lower than the WACC, and the probability index is lower than 1. Now, if we take a look at scenario 1, it is similar to Delta's case. So we can prove this with Delta's calculation. The net present value is bigger than 0, and the rate of returns are bigger than the WACC, as you can see the number, and the probability index is bigger than 1 as well. If we take a look at Delta's cash flows over the investment and the project, the payback period is 4.2 years, and the discounted payback period is 4.89 years. This is bigger because the discounted payback period takes the time value of money into account. And we calculated the accounting rate of return at 9.23%, and we compared this to the required rate of return. And this is not a credible measure of project feasibility because the required rate of return is a subjective measurement or an opinion from the investor for the project. So the next section is risk and return. Now let's take a look at Delta's return over the years. So Delta has an average return of 6% and a volatility or risk at 5.16%. Using this, we can calculate the coefficient of variation at 0.82%, and this is the ratio of risk over return. So if the lower the coefficient of variation, the better for Delta. And if we take a look at Sharpe ratio, we calculate it at 0.97. And the Sharpe ratio is a ratio of return over risk. So the higher the Sharpe ratio, the better for Delta. Now let's take a look at two other investors. On the left side, there's the investor has different rate of return depending on the state of the economy, and it has different probability as well. So using these factors, we calculate the expected return of 1.5% and the volatility at 3.28%. So the coefficient of variation according to those is 2.19 and the Sharpe ratio is 0.15. And another investor has two shares with different returns and different risks. So using these values, we calculate the expected return of 11% and the volatility or risk at 2.11% and the coefficient of variation of 1.32 and the Sharpe ratio of 0.69. And the expected beta is 1.35. Thanks, and now I'll hand over to Vishal.
Hi, I'm Vishal, and something about me, I love to read in my free time and also like to play video games as a hobby. Today I'll be explaining risk management, both long and short, and mergers and acquisition for cash, scrip, and combined. First of all, risk management long. Delta Limited is a gold manufacturer that uses long, utilizing forward contract. We had to calculate the two values provided to us to calculate how much the market gold price would be at $600 and $300 per ounce, with the exercise price being $400 per ounce for 2,000 ounces, which would be exercised in 6 months. So for $600, we see a gain of $400,000. For $300, we see a loss of negative $200,000. Moving on to risk management short, we see if they use $600 per ounce, they have a loss of negative $400,000, and if it's $300 per ounce, it will be a $200,000 gain. With merger and acquisition cash, we can see that for Pioneer Limited, after acquisition, displays the share price at $8, shares outstanding at 50,000, market value of assets at 1.32 million, net income at 490,000, market value of equity at 400,000, market value of debt at 920,000, debt to equity ratio at 2.3, earnings per share ratio at 9.8, and price earnings ratio at 0.82. With the scrip offer, you can see that for Pioneer Limited, after acquisition, displays the share price of $41.60. Shares outstanding at 64,423.8. Market value of assets is 3.6 million. The net income is 490,000. Market value of equity is at 2.68 million. Market value of debt is at 920,000. Debt of equity ratio is 0.34. Earnings per share ratio is 7.61. Price earnings ratio is 5.47. The shares outstanding for Pioneer Limited is at 50,000 and Delta Limited is at 14,423, and market value of equity for Pioneer is at 2,080,000 and Delta is at 600,000. So after acquisition of Delta Limited, Pioneer has been able to have an increase in the equity and shares outstanding. Moving on to merger and acquisitions combined, we can see that for Pioneer Limited, after acquisition, displays a share price of $42, shares outstanding at 50,000, market value of debt at 920,000, debt of equity ratio at 0.44, earnings per share ratio at 9.8, and price earnings ratio at 4.29. For Pioneer Limited, market value of assets is 3.6 million, market value of equity is 2.08 million. Market value of debt is 800,000, debt of equity ratio at 0.4, earnings per share at 6, and price earnings at 6.67. For Delta Limited, shares outstanding is at 14,285 and 71. Market value of assets is 600,000. Market value of debt is 120,000. Debt of equity ratio at 0.25, and earnings per share is at 7.5, and price earnings at 3.2. Thank you so much for attention.